Hey miners, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, Anthony Power and I are pleased to welcome back the president and CEO of CORZ Scientific, none other than Adam Sullivan, to the program. In today's episode, we're going to be going through Q2 earnings, obviously the CoreWeave expansion announcement, and a number of the other key initiatives that have taken flight this year under Adam's leadership. Now, before we get into all that, please take a second, you guys, smash the like button. It's a big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comment section below what you think of today's discussion, if you have any additional questions for Adam and team, and if you're currently holding shares. Now, with that being said, let's get into today's interview. Okay, guys, so that's right. Today's video, Anthony and I have the pleasure of President, CEO, CORZ Scientific, Adam Sullivan on the program, hot off the heels of Q2 earnings and this impressive CoreWeave upsize deal. So we've got a ton to talk about today. We're going to get through all of that in today's presentation. But before we do, Adam, thanks so much for making the time and really looking forward to this talk.
Looking forward to it as well. Thanks for having me back on.
You're most welcome. So I know we've only talked a couple months ago. We were down in Denton there, but I feel like a flurry of news, information, activity's been going on at CORZ Scientific. So why don't you give us a quick summary kind of since our last discussion, and then we'll get into some of the subsequent questions there.
Yeah, we've had a pretty active Q2. We've also had a pretty active Q3 so far as well. So Q2 was really strong. We mined 1,680 Bitcoin. We're currently operating about 19.5 exahash. We actually completed a 72 megawatt build out in Denton. We announced also the start of another 100 megawatts at our Pecos location as well. And we've removed 260 million convertible debt in that time frame since we last spoke, and we also completed a $460 million raise as well. So we've been pretty active throughout the past few months since we last spoke.
No kidding. Yeah, I'll definitely agree with that one. Hey, now we noticed some good free cash flow numbers on the earnings as well. We wanted to ask Adam, we've kind of been, asking most of the CEOs, do you know your current all-in cost to mine a Bitcoin at this point?
We do, yeah. So we actually publish this every quarter. In Q2, we published that we were $29,900 to mine a Bitcoin, and that's the direct cash cost to mine.
I notice you're also using the hash costs now as part of your presentation as well, and it was interesting to see in terms of effectively the cash costs that you're committing to on each day. I think really rightly, I'm going to say $30 a petahash per day would be the conversion to petahash. I mean, from it's low for terahash, but I mean, looking at the hash price, which is the revenues that are coming through, we did see that sort of dip to 34. So really, from your perspective, it has to go lower than the lowest of all time for you to start considering, maybe even contemplating switching off machines during that period.
Yeah, but there's also some flexibility. We talked about this when we gave our forecast for our power price expectations for the remainder of this year. So much of that is driven by what power programs we're choosing to participate in. And then in the deregulated markets, at what power prices do we shut off since we're on index PPAs? But we're also able, since we have our entire software stack that has firmware, energy management, and fleet management, we're actually able to tune the machines, whether it be low power mode, ultra low power mode, that can also bring down our hash cost. So our hash cost in Q2 was driven by what the prevailing hash price was over a Q2 as well. So there is a little bit of flexibility in that number up and down.
Yeah, and we noticed obviously that in July's mining update, there was obviously a reduction in your number of or your amount of operational hash rates compared to the June position. And I'm assuming now you're getting into the sort of like the process of refurbishing facilities in readiness for the big CoreWeave contract that starts to occur probably next year. Can you talk us about what's entailed in that preparation in terms of how you're going to relocate miners to other facilities and how you're building those facilities out?
Yeah. So it's actually an important note. We actually gave it in our July update. We're migrating exahash right now, literally as we speak, to different sites. So there's a few things going on. One, we're sunsetting our Bitcoin mining hosting business. And so that is freeing up capacity. So in Q1, we had about 600 megawatts that were dedicated to self-mining. So it was about 150 megawatts of hosting. And then as we look forward to the remainder of this year, there's a lot of megawatts turning off for conversion. There's a lot more megawatts turning on. And so we're in the process right now. We've mentioned that we're going to be doing HPC hosting across 5 different sites. And so we're actually turning off some of those sites already and migrating those, whether it be to the Denton location where we just spun up another 72 megawatts for Bitcoin mining. We obviously are undertaking the 100 megawatts at Pecos. But we also have space freeing up across a number of our different facilities, mainly driven by the sunsetting of the hosting business. And so we did see hash rate come down when we were over 20 at one point. We're now down to about 19 and a half. And that's mainly driven by the fact that we're beginning the demolition process at certain sites. That demo process is really related to the internals of the facility. And we also have to start clearing, certain spots across some of these facilities because, we have to start landing the gen sets, we have to start landing chillers, we have to start landing all these different components related to the development or the conversion to HPC. So this is a lengthy process, and developing 382 megawatts over the next 18 to 24 months, that's a very tight time frame for that amount of development, but that's all well within our capability set.
It's interesting to say that, and that was part of the next question actually, on how many sites will you be locating HPC? You've got 5 separate sites. Does that bring any challenges having it located, or effectively does it de-risk the potential challenges having it spread to more locations?
Yeah, definitely de-risk it from the perspective of, if there's any single issue at any given site, we still have 4 other sites going on. So it's interesting, as we go through this process, there's a lot of components being delivered. We're ordering, well over $1 billion worth of equipment that has to be landed pretty much within the next 12 to 18 months to actually deliver a GP-ready facility. And for the first 200 megawatts, we're delivering that in the first half of 2025. So that's a significant amount of equipment in a very large data center that's being developed in a very short period of time.
And the fact that you're already providing a service to CoreWeave at one of your sites already, is that in terms like a model of what you're going to be doing, from next year onwards, or is that a different type of service than the one you've got in the contract?
No, very similar actually. But what we did at our first data center, so the 16 megawatt data center that we have in Austin, called Hibbets, that was actually a need that they had for 16 megawatts where they needed to deliver it to a client in a very short period of time. So that was something that we were very happy to accommodate. We had high familiarity with that site, given much of our team actually used to office out of that site. So many people had very specific requests about where they wanted their desk located in their office, since they used to work in that facility many years ago, dating back to, I believe it was about 2006. So that pilot is actually mainly for proving out one of the use cases of going after older distressed data centers for conversion. And so what we did at that data center was we took a 12 megawatt data center, made it a 16 megawatt data center that was outfitted for some of the newest generation GPUs. That's something that we talk a lot about, is that's actually a big growth avenue for Core Scientific, given the amount of infrastructure across the United States for traditional data centers that is older, the power density is much lower, but sometimes you have a 25 megawatt data center that sits on a 100 megawatt substation, has a much larger power allocation, and we can actually outfit it for the newest generation of GPUs, increase the power density, and those are things that we can deliver on a much shorter time frame than these larger conversions or new builds that we're doing right now.
Yeah, and with regards to the 5 locations, I'm assuming you're keeping that tight-lipped at the moment, because I've not seen any updates with regards to where you're going to put HPC. And just to add on to that, you won't be co-locating mining and HPC at the same site, or will you be?
We won't be co-locating. And yeah, we haven't disclosed it. We're working on some additional power allocations to potentially increase some of those contract sizes above what we have currently have contracted. And so, we've done this in the past, and now it's where we're putting sites, and suddenly we end up with new neighbors pretty quickly.
Now the biggest part of this, obviously, that everyone's fascinated with, not just the retail investors, but the whole of the mining market, effectively. And if they're not saying it, they are believing it. Believe you me. Is the fact that this 12-year contract is set to deliver 6.7 billion in revenues at the moment, and if you take away all the costs, certainly all the cash costs that are going to be outlaid during that period, you've still got a net profit or a net income of 4.7 billion, which is, in terms of where we are at the moment in the mining space, a really astronomical figure when you contemplate what we've just seen in the recent earnings figures from most of the miners. In terms of receiving the advance to cover the refurbishment, I'm assuming the escrow has now started to receive funds in, and the 200 megawatts you said sort of like first half of next year. Can you sort of like give some sort of timelines on when you'll get to start receiving the revenues for the whole of the 382 megawatts?
Yeah, so revenue begins generating when we have a GP ready facility. And so our expectation is to have the first 200 megawatts fully operational by the end of the first half of 2025. The next 70 comes in the second half of 2025, and the next 112 will be ready in the first half of 2026. Now, it doesn't all turn on at once. There is a ramp up over that time period, but those are the time periods at which we expect to have fully operational status by each of those timelines that I laid out.
And the last part to this question, obviously, we talked about 382, but we know that you've indicated you're going to commit 500 megawatts to high performance computing hosting. Can you sort of indicate, are the conversations ongoing with CoreWeave, or are there potential other interested parties? I mean, having been at the Denton facility when you initially talked about the 200 megawatts and you had so much interest, are we still getting those sort of conversations for the remaining amount?
Yeah, the interest is accelerated. Since our announcement on June 3rd, we have been inundated with calls. The 118 megawatts, though, is still under option with CoreWeave for another few weeks. And so, we obviously want to work through that remaining option agreement with them. They've been a great partner to us. We look forward to continuing to expand with them. But that's the reason why, we outlined in our Q2 investor presentation that, we're aggressively looking at additional sites. We have a large site pipeline that we want to continue to pursue. That's mainly driving us, because we want to diversify our client base. We essentially ran out of things to sell. From the time that we announced that we were entering the space to the time that we sold out, essentially almost the entirety of the 500 megawatts was only a few months. And so we're looking forward to continue to add sites to our portfolio, continue to grow the business, and diversify our client base.
I mean, it looked obviously when we attended on the I think it was like the 10th of June when we came down to the Investor Day. Very fortunate to be with the Wall Street people down there, and all the questions were really focused on HPC. I mean, you just announced the 200 megawatts, but I think most people in that room got the feeling during that presentation that there was going to be some imminent announcements, and obviously this plan of 500 megawatts. Could you envisage? With regards to the fact that you've got one big customer now, do you envisage that even the 500 megawatts in the future could be increased?
Yeah, absolutely. We outlined it as a 2024 catalyst to expand our site portfolio and diversify our client base.
Excellent, thank you.
Anthony, we sound like the Wall Street analysts now talking so much about HPC. You can tell we're excited, Adam. Obviously, a huge growth opportunity. You guys really setting the pace for the entire industry. So my question is, pretty much all the miners that are exposed to HPC, when we ask them, hey, what type of business model are you interested? They say, oh, we'd like something similar to the CoreWeave deal. So the question to you is, how difficult to craft and find that type of deal was it? And how difficult would it be for other miners to kind of emulate what you're actually doing here in terms of build out and delivery?
Well, I think the CoreWeave deal was unique given the skill set that Core Scientific has. Um, Many of these folks that are looking for data centers need to have high confidence that the end builder and constructor is actually going to be able to deliver a GP ready facility. That's something that we have our own design team in house, our own construction team in house, our own operations team in house. They know that we can deliver on the timelines that we set out. And so that was really one of the main drivers of the reason why we were able to extract such strong economics out of this contract. Even as we look forward and as we negotiate with even companies much larger than CoreWeave, they appreciate the fact that almost our entire team comes from the traditional data center industry. And that's a really important factor. It's not just having the infrastructure, because you can find sites that there is definitely a bottleneck, but it's not a full restriction. Like those sites are available. The main thing is the talent in this industry is so tight. It's very hard to find the right folks. Luckily, we put together this team 3 years ago. We've been adding folks over time, but I mean, we have a big chunk of the old HP data center team. We have folks from Switch, DataBank, Equinix. We have folks in Digital Realty. We have folks from some of the largest data center companies in the world in our company. And so when we are having conversations, they have high confidence that we can design and deliver exactly what we're pitching to them. And I think that's really what separates us from a lot of the folks in the Bitcoin mining industry, is the fact that we actually come from the traditional data center industry. And so, as we look forward and even as we have conversations about future contracts with new clients, the way we're thinking about it is, how do we optimize the CapEx versus the CapEx essentially acts as a buy down on rate. So how do we optimize the CapEx versus what we should finance versus what the ending rate should be? And that's really the optimization formula that we're going through. And those change between investment grade counterparties and non-investment grade counterparties. And so it's finding the right mix of those clients. And so we're at the point now where we're actually just trying to work through how do we optimize for that right client mix versus other people who are just trying to find the first client at this point.
Makes sense. Now, another question for you. You mentioned you've ordered about $1 billion worth of equipment. It's landing in the next 12 to 18 months, fairly tight timeframes. Two-parter, were there similar lead time concerns to what we've seen on the Bitcoin mining side in terms of infrastructure, power stations, things like that? And do you have any concerns with these timelines that there may be some bottlenecks or delivery issues?
I would say supply chain is the one thing that keeps us up at night, right? It's something that Bitcoin miners are ordering some of the equipment, but every data center in the world is trying to get access to this equipment. Luckily, we've been able to access a number of different supply chains given our relationship with CoreWeave. And so that's been very helpful as we've been working through not only what our plan A is, what the most optimal solution is for a build, but also what plan B and plan C is. And so we've been working through all of those different components of the supply chain to ensure that we have backup plans. And so if timelines are going to slip, at least we know that they're only going to slip by, a few weeks or a few months versus in some cases, some of these components are back ordered, nearly a half a year or a full year from the timeline of when you actually expected to get them delivered.
Yeah, no. So I mean, I think you've already alluded to this, but with regards to obviously, the build out of the new facilities and the removal of miners. I mean, you probably expect a certain amount of downtime in terms of mining rate because you've got to physically move miner from location to location during this period. But I suppose is that helped by the fact if you're closing down the hosting contracts, that gives you some sort of like it can limit the amount of of issues that could occur.
No, you're absolutely right. That's exactly what's been happening. We've been able to sunset certain hosting clients, and then we've been able to backfill them with our self-mining units almost immediately. So we have them ready to plug them right back in the moment we're unplugging the other machine. That's a big part of this. And then the other part is as we start to turn off, some of these sites in terms of turning them off to do the full HPC conversion, based on where we sit in the supply chain, we've said, well, we should operate this for X number of more months, this facility for X number of more months, and then we'll actually be able to pair that up with the PACUS turn on. And so that's this whole Tetris game that we're playing with machines and making sure that we keep as many machines on as possible at any given point in time.
Yeah, that's awesome. That was actually my question indented to you, Adam, was how are you going to engineer an HPC aircraft while you're flying the Bitcoin aircraft? And lo and behold, you guys figured it out again. So hats off to you. That's a great solution. Now, the next question has to do with the CORZ warrants. So we're shifting gears here a little bit. CORZ W warrants. The CORZ Zs were penny warrants, so those convert pretty easily. These ones, people actually have to come up with the money to buy the shares. Were you concerned with the pace of conversion on the CORZ Ws?
Not as concerned. As we look at the CORZ W, that's a cash exercise warrant struck at 681. There's still a significant amount of option value embedded in that. So above the value that the stock is currently above 681. There's additional value on top of that, the option value. That's mainly related to the time value right now. So there's just less than about 2.5 years on that warrant. And warrants generally don't exercise unless that option value starts to come down. There's two reasons. One is time, or two is how far in the money is it? And so, what we're seeing is unless the stock moves much, much higher from where it is today, or we move out, about 12 to 18 months from now, we don't expect to see a significant amount of conversion on the CORZ W, unfortunately.
Just a line to that, talk us through the process. I mean, obviously in Chapter 11, you're coming up with all these discussions, all these plans, with really no certainty of how things are going to pan out. And believe you me, 2024 couldn't have gone any better for you guys so far this year with the amount of, I'm trying to work out if there's actually been a bad update this year. I don't think there has. It's been update after update of really good positive news. But when you're putting that plan together during Chapter 11, and you're saying the CORZ warrants have got until, I'm going to say January 2027, and 2 years on top of that for the CORZ Z warrants, which isn't as much an issue. How did you determine that sort of time frame? Was it a case of like, well, if we're going to recover from a company that's valued at a few $100 million to one that gets to a market capitalization where this becomes then relevant for shareholders to exercise that warrant? Were you thinking it's going to take longer than it actually did? Because I mean, it only took 5 months to get the share price above those limits, and it's like, I mean, it's great now saying, well, I just wish we'd have done it for a year or shorter. Or was it a case of you had to take advice from the market, from the guys, the institution guys, to say this is the best way of looking at it? Bear in mind, the share price was 4 cents if we go back 20 months ago.
Yeah. I mean, I think you have to remember we went through a 13-month battle with our creditors. The creditors wanted to own the company. We ended up with one of the most successful solvent debtor cases in history for equity holders, and we had to have mechanisms to pay off the debt. Well, we had another mechanism, but we'd have a mechanism which was the CORZ EW to actually pay off all of our outstanding debt. And so that was really the mechanism that was built in. The assumption wasn't that we were going to do this inside of a year, right? The assumption was, well, as the company continues to grow over time, we should be able to get to, above 681. And that was mainly discussions, between the creditors who wanted to get paid off. So all of our documents are structured they're really structured for us to pay it off early, or they always have to protect themselves about a second Chapter 11 case. And so those are how bankruptcy documents are structured. The expectation was that we were going to, get the proceeds from those CORZ EWs at, year 2 or near the end of year 3 when it was expiring. So, that part was, I would say the ramp up of this business and how successful we have been was not expected by the creditors. And, that was something that we were able to actually prove them wrong on.
You're in Chapter 11. I'm assuming you weren't having like discussions on HPC then, or the delivery of HPC, or at that point in time? So it's not a case of like, you know what, we think we're on something here, it's going to be a real winner. It's a case of you didn't really know, and so therefore you allowed a period long enough for the share price to actually get to that period. And likewise, every update you provide this year has just been strength, strength, strength. Now we're coming on to one of the most recent updates. And so we just need to, and we can see why you're doing this, but we'll get you to confirm that. But you've just gone out and issued a convertible note, I believe at 400 million, which is increased on the initial, what you were looking to do because of the oversubscribed amounts of that. But just tell us the process of how this comes about in terms of how much, in terms of like the interest rate, in terms of the duration, and probably more importantly, what's the impact to Core Scientific and the impact to retail shareholders? Because, I'm a shareholder, and there's going to be a lot of shareholders listening to this podcast and sort of like can see parts of it, but don't understand how it all fits together and how it impacts them in the long run.
Yeah. So I'll start at the beginning, and then you guys can ask more questions as I roll. So we went through a full process right after we signed the CoreWeave deal about how do we finance this company going forward. We had very restrictive covenants in first lien and second lien on almost all of our assets via the delayed draw term loan, which is $61 million note, and the $150 million senior note. And so we were trying to figure out, as we were evaluating different debt structures, that debt was essentially things that we had to take out in order to do any type of asset-backed financing or any other financings. And so as we were evaluating the rates on either structuring something against the contract, against any of our existing facilities, that's where we started to realize, well, the rates aren't really where we want them to be, the cash interest rates. And almost all of that debt is going to come with some type of covenants until these contracts start to cash flow. The moment these contracts start to cash flow, the rates for traditional debt comes down significantly. So instead of looking at like SOFR plus 600, you're looking at like SOFR plus 250. And there also comes with a lot less covenants, a lot less restrictions, et cetera. And so as we were rolling through that process, we started to evaluate more equity-linked style deals. The convertible note obviously is attractive to us. Very low cash debt interest rate. That's something that's going to be able to lower our total interest rate on a cash basis much lower. Our interest rate on the existing debt was 11.7%. And so as we were evaluating convertible notes, you take into account a few things. One is your credit worthiness. And as we look forward, our credit profile is going to significantly improve in 2025. The other part, though, is our volatility. We're like an 80 vol stock. Well, next year, we might be a 40 vol stock because the amount of cash flow generation that we have from the HPC side of the business. And so that's what really attracted us to a convertible note at this point in time, recognizing we still have another 12 months where Core Scientific is still really an equity story until we start having much more stable free cash flow generation. So that's been, that was our kind of our thought process leading up to the convertible note deal. And then as we were targeting the 350 in the initial announcement, the ranges came in, it was 350 with ranges of 3 to 3.5 and a premium of 25 to 30. Now, after the first wall cross day, we were already, essentially at book size. And then the moment it flipped public, we actually had one of the most successful offerings of 2024. Very few companies are able to not only upsize, but come in at the tight end of the range. So the 3% up 30. So we had a very successful offering, very significant institutional demand, very significant long-only demand. And, we were happy to upsize given that we were able to allocate to some of our largest shareholders who we know are outright long on not only our equity, but now we're going to be outright long on our convertible note. And so it made it a very attractive instrument for us. We're going to be paying down debt as part of this. We're going to be removing all of the collateral. We're going to be getting rid of very restrictive covenants that were remnants of our Chapter 11 process. And now at this point, we're sitting in August, we're 7 months out of Chapter 11, and we're going to essentially say, Chapter 11, what was that? because we don't have any of the debt left over. There's no restrictions. And now it's all smooth sailing from here. But the great part is we're going to be able to pay off some debt, and we identify this in use of proceeds, and we've identified it as a 2024 catalyst. We want to go out and acquire some additional sites. And so that's what additional cash that we're putting on balance sheet is mainly going to be used for.
So just to clarify, I mean, I think I've got the number in front of me, but I'm thinking 318 million is the debt that you had on the balance sheet as at the end of, as at when you reduced the bond, which was 260 million. Are you saying that 318 million debt will be repaid with this convertible note?
It's not necessarily all of it. Some of it, it's not necessarily all of it. Some of that debt is actually very low interest rate debt. And so some of that we may actually keep on balance sheet just due to the rates, and it's more attractive for us to keep that on balance sheet and pay it down over time. But yeah, absolutely. The $150 million senior note and the $61 million delayed draw term loan, we have to repay those. We have to be able to release this company and get the handcuffs off the business.
And who physically decides on the 3%? Is that something that you're part of, or is that the market determines what the rate will be?
It's a little bit of both. It's us working very closely with the banks, working in their sales desk, working very closely with the end buyer. We were very lucky to have some very good anchors in the deal that were coming in on the tight end of the range these firms are very supportive of the company. So, we're very lucky to have engendered a lot of trust with a lot of very large shareholders.
Yeah, I mean, it was obviously noticed at Denton earlier this year when we had the full house there and the full coach to get there. One more question on the convertible before you is regarding conversion. So, I mean, explain to me and explain to most of the retail investors that won't understand. But there's the conversion is at $11. What does that actually mean? If, say, for instance, if the share is by the time of conversion $50 a share, what does that mean for those people holding these notes when it's due in 2029 when it's due to be converted?
Yeah, so there's a specified number of shares that these convertible notes trade into, and so that's something that's fixed at the beginning. So it's not like it converts into a larger number of shares. So that number is already fixed. So the dilution is already fixed. But we also have the optionality to actually pay down the principal in cash as well. So that's something that could help reduce dilution in the future, which is really important to us because we obviously believe that this company is going much higher than where we are today. We believe we're going to be able to create a significant amount of shareholder value creation over the next few years. And so that's a small clause in our convertible note that we believe is actually very important to us looking forward.
Yeah. Now, Anthony, you bring up the Denton investor meeting, and Adam, you talk about the institutional interest, some of the core anchor clients for this. Can you give us just an update on the institutional landscape, the amount of institutional ownership in CORZ, and how that kind of relates to some of your peers?
That's a great question. I believe we are sitting above 50% institutional ownership. I believe that is one of the highest of the peers, at least in the Bitcoin mining space. But that's something that is continuing to grow. I mean, we are in a very unique position right now where we have a very strong story, a very strong growth of our business. And I would say institutional investors are very attracted to the high performance compute story. And so we're out in front of investors on a almost a daily basis here. And these are some of the largest investors in the world that we're speaking with now. And what they're telling us is they believe we could strongly become one of the largest data center companies in the United States. And we're right there with them. So there's a chance here where in the next 2 years we could be the third largest publicly traded data center company in the United States. And we think that's incredibly attractive, not only to our existing shareholders, but to institutions as well.
I was going to say, Anthony and I believe that as well. And don't forget about us retail investors once all these institutional guys are in there. You mentioned about taking the handcuffs off the business. One of the aspects there is obviously the ability to do M&A activity. I know the HODL situation, selling your Bitcoin, was one that you highlighted. Are there any other quote unquote handcuffs that we should really be aware of that are hindering the business right now?
Well, it's really what was hindering the business. And so what was hindering the business was the fact that there was a first and second lien on all of our assets. And the fact that that's gone now allows us to actually go out and get much cheaper financing on an asset level basis. And that is very attractive to us, especially as we start migrating sites to HPC. We can start financing the business much more similar to a data center company. We can start lowering our cost of capital. The entire business of data centers and Bitcoin mining is a cost of capital business. It is how low of a cost of capital can you have on a high CapEx business, because that's going to allow you to generate greater returns. And so that's what we're focused on right now, lowering our cost of capital going forward. And finally, the handcuffs are off on the first and second liens, and we can actually go out and do some of these potential debt deals that we were evaluating just a few months ago.
With regards to raising capital, I'm assuming that the opportunity of an ATM wasn't part of your portfolio. You could or part of your lever that you could access initially. Would that change now? And what's the time period before you could start using an ATM to raise capital?
Yeah, so that's not necessarily something that we're looking at. The way we're thinking about the business is, we want to ensure that we're not causing excess dilution for where we're at as a company. Where we're going to be at in 2025 is much different. We're going to be a business that can generate a significant amount of free cash flow, much more attractive for very low cost debt in the debt markets. Today, the reason why we did the convert is we do believe we're more of an equity story for the next 12 months until we start generating a significant amount of cash flow. And so that's why it was so attractive to us to go after that. And looking forward, there's probably going to be a lot more structured debt on the balance sheet over the next few years. And at that point, hopefully there's very minimal, if any, dilution going forward to our existing shareholders.
And that's obviously due to the predictability of the revenues from the HPC business, really, which you can't get from Bitcoin mining effectively.
No, debt in the Bitcoin mining industry is extraordinarily expensive. And so the entire part of the HPC story is continuing to drive a lower cost of capital. And that will actually aid our Bitcoin mining business as well. So, it puts us in a really strong position here that I don't think many people will be able to catch.
In terms of, sort of, I'm thinking 2025, 2026 now, when we start seeing those revenues come through, and also at the same time you'll be repaying some of that the amount that you effectively borrow, the 575 million that you're going to borrow from CoreWeave to refurbish these sites in advance. But when you start bringing in sort of over 400 million of net profit a year, you from your previous role would probably think, what should that give us as a sort of like a market capitalization, just based on the HPC industry, and what sort of price earnings ratio would you put on technology at the moment? And looking at your market cap today, which is probably hovering around 2.3 billion, I think there's probably maybe a little bit more scope for that to increase, just based, not even including the Bitcoin mining, but just looking at the HPC as an isolated business for you.
Yeah, just looking at it as an isolated business. Well, the one thing I'll say first is I don't think our market cap makes much sense today, because we essentially trade like we only do Bitcoin mining. We haven't signed $6.7 billion worth of deals in the HPC side that's fully contracted for the next 12 years. So that's the groundwork. But on a go-forward basis, we should be trading in the mid-20s on an EBITDA basis if we're to trade with the data center peers on that side of the business. So it's a pretty significant uplift from where we sit today.
And in fairness, I believe certainly a lot of other miners who have other businesses apart from Bitcoin mining are feeling the same sort of like issue at the moment. They're not getting recognition for. I'm sure if we got Sam Tabar on the podcast tomorrow, he'd articulate that he's getting no recognition for, albeit it's a smaller deal than you guys, but actually he's getting a deal and he's getting those revenues now. So, but they're not getting any sort of like effectively any recognition for that, and it's nearly 100 million a year annualized from August. So, I think the market just needs to wake up and understand what miners are doing, and some miners are doing probably small amount of self-mining and lots of other things that they're not getting the benefit for. So it'll be interesting to see how that goes. Now, I mean, looking today, you're sort of close on the heels of catching Riot Platforms and CleanSpark, actually. So I don't know if it's a case of if, but the case of when. Really, that goes ahead, and then there's only one ahead of you then, and I'm sure you've probably got your sights set on that in the not too distant future.
I was gonna say, Adam, don't be telling people this stuff. We want to be buying our shares below $10, so we don't want to hear about forward multiples and HPC and all that.
There's going to be a delay on this podcast going out, probably by about 6 months.
Hey, now Anthony already alluded to the number of positive news stories here. Anthony and I have talked personally. It's like a snowball effect, right? The more positivity, the more the ball starts rolling, the better interest rates, the more debt options. It just opens up a whole new pathway. So I almost feel silly asking you this question because you've had so many good news stories. But what should we be watching for catalysts here on the horizon, Adam?
Yeah, we outlined them actually in our Q2 investor presentation. So executing the remaining 118 on the option agreement with CoreWeave, acquiring new sites, and diversifying our client base. Those are things that we outlined as 2024 catalysts. We needed capital to do some of those things. So, we're looking forward to the remainder of 2024 and being very active here.
Now, one big thing we haven't discussed, and so we've all alluded to that, and it's just come to my mind now is, well, two things. One is, I think when we last spoke, Bitmain have got a 5% ownership of Core Scientific, or they certainly did. I'm assuming that's still the same. They wouldn't. Why would they sell their shares with all these news stories going through? But linked to that, you're now going out there and have a deal with Block to deliver a significant amount of miners this year. Now, Block are a new entrant to the market. We've got the sort of the three big traditional ones, the Bitmain, MicroBT, Canaan, and there are other ones out there. But we've seen this year a number of new entrants like Auradine, like BitDeer, are going into the space, and that's not as unusual as it sounds because we know where BitDeer came from. But you're going with Block, so can you tell us a bit more about these machines that you're buying? Because I know in your presentation that you've actually quite clearly put down the breakdown of all your machines, and it does look like you've got a significant amount of sort of like the S19 machines, which are, in terms of efficiency now, are probably, they're obviously less efficient than the latest machines on the market. So we're seeing miners now start to replace these, and it looks like 2024 is for you, not about growth of hash rate, but about replacing more efficient hash rate. Would I be right in saying that?
Yeah, you're absolutely right. I mean, we're going to have 500 megawatts operational. We're going to try to continue to refresh those and be very specific about when we're going to do it and where we're going to do it, because we want to create and generate a strong return on invested capital. I know it might be a new concept for some of the miners, but we actually want to produce a strong return on our mining business, because that's why it's there. It's there not only to have the upside of Bitcoin, but it's actually there so even in down markets and middling markets that we can still generate a good return. And so that's really what the business is focused on. And the deal with Block is exceptional for us. As we look forward, we know form factor is going to change. We know this industry is going to continue to get more efficient. We know that the fact that we've been designing facilities around a shoebox for the last 7 to 8 years is probably not the most efficient way to do it. And so our deal with Block is actually only buying chips. So we're designing our own hash boards. We're designing the new chassis that are going to house all of these hash boards. And it's going to lower our CapEx costs because we're actually able to design those chassis to actually eliminate some of the electrical infrastructure in the facility. And then on top of that, going forward, as we replace hash boards with newer generation chips, we're just going to be able to slot in new hash boards, pull out the old hash boards. We don't have to replace all of the other componentry related to the facility. And this is part of a major form factor change that we're going to see the industry go through over the next 5 years as we continue to scale as a company, as the industry continues to scale, this is what institutional Bitcoin mining is going to look like. It's not going to look like what it does today.
And do we know what sort of I mean, I'm assuming you must be close to testing these machines. What type of efficiency levels can we expect? I mean, BitDeer have quite clearly listed what they're doing at the moment. Their first generation came out 18 joules. The 14 joules will appear within this quarter, and they're looking at 10 next year with an aspiration of 5. And it is aspirational at the moment. That's not, don't overdo it. But where are you with Block and the chips that you're going to be buying from them? Because it looks like you're actually doing what BitDeer are doing. They're buying their chips from TSMC and building the machines themselves with the chips that they've purchased. And like you just said there, it's obviously it's a cheap way of doing it and saves significant cost.
Yeah, so we're not doing the ASIC design. Only Block is doing the ASIC design. And then we're just buying the chips from them. The one thing I'll say is, we're not at liberty to disclose the efficiency yet. That's something that we'll be looking to Block's guidance in terms of when they're able to announce that. But I would say if Core Scientific's done a full evaluation, you would have to expect that they're going to be strong performers in the market.
Yeah. Okay.
Hey, Adam, just a quick follow-up on the form factor. This came up in Riot's tour as well, talking about the immersion tanks, and they're designed for certain size and layout of these machines. When you talk about form factor, can you give us a little bit of more color there in terms of what that allows you guys to do with racking and spacing and replacing machine? What is the benefit there?
Yeah, the benefit is, you can be running a lot more hash boards inside of a single, I'll put in air quotes, chassis, because the chassis are going to look much different going forward. The chassis are going to be much more optimized for airflow, much more optimized inside the facility, much more optimized from an electrical componentry standpoint. And so that's really what the change looks like. It's probably going to be bigger machines, more hash boards. And so that cuts down on all the other components you need, like power supplies, control boards, etc. And it also allows you to, be much more nimble in terms of replacing hash boards. And so our hash boards are designed for quick repairs, easy repairability, faster repairability. And then it also, if you're building your own hash boards and buying your own chips, you can be much more adept in terms of just slotting a hash board. If one machine only has 7, but another one has 8 in it, you can just take the extra hash board and slot it into the one with 8. And that's what the exciting part is for us, because it also makes transportation between facilities when we're moving machines around. Once you start only moving hash boards and not moving entire machines, you can essentially transport tens of thousands of machines, but you're only transporting hash boards. So that lowers your logistics costs, speeds up your logistics costs, or speeds up your logistics, and it makes your entire business more efficient when you're only worrying about hash boards and not worried about an entire machine.
Awesome.
We spoke to a number of the what we class as like the pure play miners, and they obviously want to maintain that Bitcoin mining and try to become the best that they can in that business. I mean, the HPC story is really the story that's current. It's 2024. Everyone's talking about HPC. We realised that we were the only two that asked a Bitcoin question at your investor day. Felt a bit silly afterwards, actually, but we thought we were there as sort of like in the Bitcoin mining space. We better ask at least a question on Bitcoin mining. But sort of in your sort of like your analytical side of your brain, at what point do you think the Bitcoin price changes the conversation maybe towards mining again? Because at the moment, I mean, nothing can compete with those revenues there that you're achieving, and actually some of the revenues that other miners are achieving in the HPC space as well. It looks like they're doing better in that particular segment than they are in Bitcoin mining. But there must be a point in your head that actually thinks that when we get to this point, the conversation starts to change. But do you have a feel for that yourself?
Yeah, it's hard to say because it depends and split between institutions and retail. I think institutions are going to have a hard time ever really coming around to the Bitcoin mining business. I think they're forever going to be focused on long-term stable free cash flow generation. It's the holy grail for institutional investors. So I think for them, that's forever going to be the conversation. In terms of what we're discussing, I mean, when we talk about our business, we talk about the HPC business and the Bitcoin mining business. We've been one of the best Bitcoin mining companies dating back over 7 years. We've been one of the largest Bitcoin miners since 2021. It's very rare to find a company that's been such a strong performer then make such big announcements in another industry. And I think that's what's exciting people right now is the fact that, we've proven we can do Bitcoin mining better than everyone else. The question now is, how good are we at HPC? You look at our team, you look at our execution experience in the past, that's what's giving high confidence in our ability to execute on this business. Because I think, I'm hopeful that other Bitcoin miners announce deals. It will be I label that as an external catalyst to a lot of people, just confirming the thesis that these facilities can be converted. But I mean, we laid out the entire process. We laid out exactly how you convert a Bitcoin mining facility to an HPC facility. For Bitcoin miners that are listening, you can watch it. Matt Brown gives a good explanation on it on the June 12th Investor Day presentation. We laid out all the contract economics. We essentially laid out exactly how to do this. And we're hopeful that, we see some other announcements because I think it'll help our valuation. Because right now we're sitting essentially, almost alongside of companies that haven't made announcements, but people have the expectation that they're going to make one. So as we look forward, we're hopeful that someone makes an announcement and that the tide lifts all boats here.
One thing that you must be applauded for is the fact that you went from 200 megawatts to 382 megawatts in a very short space of time. But more importantly, looking at the numbers, you've managed to absolutely get the same rate of revenues for the extra 182 megawatts. We've noticed other miners when they've increased their HPC, they haven't, and actually, the economics would back that to say that, the great deal's the first one, but every deal after that is subsequently there's going to be margin taken away because we're giving you more. But you've managed to maintain the whole, well, it looks like it from the model I've seen anyway.
Yeah, so the option agreement, so when we signed the initial 200, the option agreement for 300 megawatts was on the exact same deal terms. It takes time to complete designs. In order to get to definitive documentation, you have to complete designs, you have to confirm where you sit in the supply chain, get your allocation, and then find out when that's going to get delivered, and then you can actually sign definitive documentation. Because if the moment you see someone make an announcement and they've announced that, it's going to begin in X time period, but they don't have the designs complete, well, then you're like, oh, if they don't have designs, that's probably going to take a few months. And if they don't have the points where they're at in the supply chain, then they have absolutely zero idea about when this is actually going to get delivered. And it takes time, like, you're seeing it now as we go through this process on the option agreement execution. It takes time to work through all the definitive designs to actually get to definitive docs.
No, it's interesting to hear you walk through this, and I'll definitely throw up some of the presentation notes you've discussed throughout today's interview, Adam, just to help the viewers kind of visualize some of these concepts and topics. But we appreciate you walking us through that. I wanted to give you the opportunity before we hit the hour here to just give any closing thoughts you may have. Anthony and I really appreciate the hour you've allocated us, and so do all the retail investors watching this. So the floor is yours for any final thoughts, Adam.
Yeah, I think I'm just going to reiterate what I said in our Q2 call. We've made tremendous progress this year, and we've executed on a significant amount of items in a very short amount of time. We've constructed, or we will construct over 2024, over 172 megawatts of Bitcoin mining infrastructure. We've been able to completely almost redo our capital structure within 7 months from emergence. We're executing on our HPC strategy. And we've outlined 3 major catalysts for the remainder of this year, continuing to exercise the 118 option agreement with CoreWeave, acquiring new sites, and diversifying our client base. And everything we've said so far, we've been able to do. So we're pretty excited about what we've said so far and how we're going to execute on that in the future. So we appreciate everyone listening to Core Scientific for another day.
Of course. Hey, you guys, we'll leave the corporate website linked in the video description below. Take a look at the presentation, some of the decks. There's awesome content from Core Scientific available. Adam, again, we appreciate your time today. You guys, if you're still watching, smash the like button for Adam. Feel free to subscribe. And if you have any questions or comments that we weren't able to get to, throw them in the section below. We'll be sure to add them to our list next time. Anthony, always a pleasure. Adam, have a great rest of your day. We'll see you guys tomorrow.